Yeah, yeah, I'll remove that. Voila, those two slides, last two.
Krishna, you'll have to mute. Good evening, everyone, and thank you very much for being with us today. I want to start first with an apology. Uh, we had promised all our partners that we would look to do this session with all of you every month, and it has been remiss. We did not do this over the last month and a half, and so I want to personally apologize and assure you that we will make sure that we have this conversation every month because, to my mind, this is the best and easiest way to make sure that all of our investment team members are able to share what their thoughts are on markets. And for you, it's an opportunity at one level to ask questions, give feedback on what we are doing with your clients' money. And it also gives, I think, what is more important, an opportunity for folks to raise questions and issues that perhaps affect their businesses and their customers. And sometimes that conversation is actually equally useful, not just to the person who asked the question, but it is as useful to everybody else. So, as always, I would encourage you to ask as many relevant questions as you need. And as always, I will promise to keep my conversation short for now. Uh, just a few thoughts. Like I said, it's been a while. Uh, and to my mind, what's been very interesting in the last 3 months is I almost feel, and this is from, as you can see from the screen, lots of gray hair. I almost feel like we've lived an entire market cycle in the last 3 to 6 months. Uh, and the number of developments today that any investment person has to deal with uh, is not anything I envy. Uh, and therefore, I think it is probably much more important to have these conversations between ourselves and you today than ever before because there is so much going on. At the end of the day, however, what never changes is the principles of investing. And so I continue to believe that, markets will keep doing their thing. There will be positives, there will be negatives. But at the end of the day, the India story remains intact. The fixed income rate come off that we spoke about quite often in the last 3 to 6 months seems to have been finally started to happen. And so there are very interesting opportunities to my mind. I just want to spend a little time to focus on something that at least I am observing from my experience, and I wonder whether it's somewhat of a missed opportunity or whether we're not learning enough for what transpired between October to January. And the point is, what is very, very bemusing, and I'm sure a lot of you will share it when we come to the Q&A session. It is challenging today for somebody to commit money to work, additional money to work. There are so many questions. Now, I'm sure when we hear Rahul and Krishna, there will be a lot more clarity around how sensible it makes investing depending on the time frame, etc. But I want to draw your attention to the role I think hybrid funds can play in this journey. uh, Very surprisingly, one would think that if equity flows have dropped, if you remember in the months of November and December, when AMFI releases its monthly numbers, we had almost hit 50,000 crores of net flows with about 26,000 crores of SIP. If you look at the last 2 months, the flows have changed from 50,000 to 27,000. That's almost 50% down. SIPs have remained intact at 26,000. What that's telling me is that customers are being a lot more careful about what they are choosing to invest in and the amounts that they're choosing to invest. So, effectively, given the volatility in the markets, clearly investing in a gradual fashion that SIPs allow you the opportunity to do, or systematic transfer plans, seems to be a preferred choice. The fact that gross flows have come down to the extent they have, which basically means the inflows of SIPs is pretty much equal to the total net inflows of the month, means that clients are slightly more risk averse today than they were 3 or 6 months ago. The most normal thing for clients to have done should have been moving down the risk curve. You're convinced about equity in the long term, but you want to take some risk off the table. The next port of call should have been hybrid. Just like you've seen a shift of people moving from, to some degree, small and mid cap and thematic funds to multi cap, flexi cap, large cap. I think the move should have happened to hybrid, but it hasn't. And I think in that is a big opportunity for a lot of us, especially as at this juncture. Besides the conversations that we'll have about the equity funds, I just want to draw your attention to three funds in particular: aggressive hybrid, equity savings, and balanced advantage, as three products that I think probably are a much easier tool for you to equip your clients with incrementally than perhaps what the flow situation is indicating. So I'm going to stop here for now, but I just want to just summarize that this is should not just be a conversation about equity and fixed income, but I think the time has come for us to have much deeper conversations about hybrid. And I'll leave it to the Q&A to answer any questions that may come on that. With this, I am going to turn it over to Rahul, and then we'll follow it up with Krishna and then Q&A. Thank you so much.
Sure. Thanks, sir. I'll just have a small presentation to share. Yeah. Hi. Good evening, everyone. I'll just sharing you a brief presentation.
Rahul, it's not the full screen mode again. I think, Rahul, in the interest of time, you may proceed because it's reasonably visible.
Yeah. So we'll just cover broadly talking about how the markets have moved and a bit about central bankers across the globe, update on the India and US, and how are we thinking through in our portfolio. How the markets have moved. Broadly speaking, we've summed up the last 1 year journey. RBI has cut rates by 50 basis points, but what is more interesting is it has the RBI's cut has been more exaggerated, which we saw in the 10-year GSEC. It rallied by close to 92 odd basis points. 1 year CDs fell by 93 basis points, and 5 year AAA bonds fell by close to 100 plus basis points. So it has been a very large movement in rates in the last 1 year. Uh, you so that's one. Of course, aiding the fall of the rates was a dramatic drop in inflation, close to another 150 basis points of CPI inflation fall. A large part of it was because of our fruits and vegetables, which the food component of inflation has slowed down remarkably. The US 10 year, which we thought should have also come off reasonably well, hasn't come off. So the gap between the US 10 year and India 10 year is standing very, very close. I mean, it's rarely been this close. Somewhere in 2000 2001 on we had been this close, but not now. So while if at the start of the year you would have told me that the US 10 year would have not moved much, we would have said the fact that okay, probably India rates would not have also moved much. But as it turned, that we kind of have moved away from what the US numbers are, and we have had a trajectory of our own. It needs to be now seen as to how far can we hold ourselves on our own, because remember the fact that as spreads between the two assets become lower and lower, investing into a higher rated sovereign is a preferred choice. Yeah, and also you kind of get into the and you also get a marginal as a foreign investor, you can also get a marginal rupee depreciation or a dollar appreciation. So as the spreads have narrowed, it becomes an interesting choice. But if as a foreign investor, would you want to buy a US treasury, and after adjusting for the probable currency depreciation of the Indian currency, how does that move? So we are at an interesting level at this moment. In terms of the returns, what is more important is the last 1 year, and this just shows you how the movements have been in the last 1 year. The shorter end of the curve has given you 9%. A pure gilt index fund would have given on an index level 12% plus, and a composite of 50-50 would have given you 10%, which is in a 3 year and a 1 year bucket. I think this is one of the largest returns an investor has gone through, either on a 3 year point-to-point return or a 1 year point-to-point return. So, how does the global action look like? In May 25, we have had nine central bankers cutting rates. In this entire March and between March and May 25, 20 central bankers have cut rates. So,
Rahul,
largely,
Rahul, sorry to interrupt, but I don't think I'm not at least seeing the slides moving. It's still the same fixed
yeah,
income update is still showing.
I'll just try again.
Yeah, if you could just, yeah, because
Sure.
yeah, it is. It's at least moved to that slide, but it's still
Is it visible now on a full screen mode?
no, it's not.
Just a second.
Apologies to everybody on the call, but fixed income is complicated as it is. Without a slide, it just makes it tougher.
This is the PPT.
कोई भी करो.
This one.
हाँ,
Yes, it now is fine.
Yeah, yeah.
sure. Thanks. Okay, sorry about that. So this slide shows, as I was talking previously about the 1 year and the 3 year return. One of the best years for a 1 and a 3 year basis also. A large part of it, what has happened, is in a 1 year basis. So this is a broad slide on how central bankers have done across the globe. A large rate cutting cycle still remains. 20 central bankers have reduced rates between March and the right side just points out towards how the rate cutting cycle has happened. Only Brazil and Japan have had a rate hike cycle, but broader aspect is the world remains in a rate cutting cycle. The latest being Indonesia, in terms of emerging markets whom we look at, has also cut rates by 25 basis points. India, the expectation is that we cut rates twice in this calendar year, uh, but maybe, just maybe, we do another one. That is a total 75 basis points that we think we will be cutting rates. Uh, I'll be also discussing a bit about the fact that today the India 5 year is close to 595, which is below the existing repo rates of 6%, which means that the markets have already priced in a rate cut of which will be there in the June month of 25 basis points. And our thinking is that there is the market's pricing a bit more aggressively the rate cuts in the future. And at this moment, it likes like markets already priced in a 50 basis points of rate cut, and we have some numbers to prove that. So on India side, I mean, so this is our North Star. So what's our North Star? In terms of the returns generated, I mean, what we call, had you invested in every 1 month on the CRISIL Dynamic Gilt Index, which is a long-term index, the 3 year XR return, or what we call a classical 3 year SIP return, on a 36 months would have been close to 10% plus. This is kind of a historic high in terms of the investor returns over the last 20 to 25 years. Any returns beyond this, I know there will be always question about the base effect, the starting point of the lines, but since it covers a long period history, more often than not it covers that portion of it. Any returns beyond this is usually indicating an exogenous shock. The exogenous shocks in the past have come from either the COVID or demonetization or Brexit, but it has never been on an economy on its own or a central banker cutting rates on a steady state basis. What I mean on a steady state basis is if the the growth that the RBI talks about at 6.5% remains at 6.5%, and the inflation follows an RBI broader trajectory, much a kind of it has been priced in by the long end of the curve. A large part of those cycles have been done by the longer end of the curve, and beyond, if you need a larger movement beyond this, it means there's an exogenous shocks. Classically, portfolios cannot be prepared for exogenous shocks. So what happens in an exogenous shock is that RBI responds much more fiercely, as it did in COVID, as it did in demonetization, where it started cutting rates. I do not assume that will be hit by an exogenous shocks and hence RBI has to cut rates. But at this moment, on a steady state basis, on a long term equation, we are fairly priced in the RBI rate cuts. But what would be our thinking is that as so most of the trades are now happening out of the liquidity corridor because there's a huge liquidity in the banking system. That is where the meat lies now. That is in the classical 3 to 5 year segment and not in the long term segment. A large part of the long term segment has been priced in. So we're of the opinion now that since the long end of the curve has largely been priced in across our portfolios, we will start moving across the shorter end of the curve, which gives us the room to play for the liquidity. A part of the short end of the curve has also not priced in fully the RBI rate cuts. So if you were to ask me across the yield curve, which segment allows value at this moment, it's around in the 5 to 7 year segment. The 10 to 15 or beyond that has largely priced in RBI, has largely priced in the inflation risk has also been priced in. So so the value exists now in the 1 to 5 year segment or the classical 5 year segment is where their fundamental value remains. But a large, as I would emphasize, a large part of the long end of the curve has already started pricing in very aggressively of RBI future rate cuts. One of the things that would probably help in this entire liquidity stroke short end of the curve has been RBI's. People are expecting today the announcement to happen about to RBI to potentially give a very record breaking dividend. We're estimating the markets, the budgets uh, had said the fact that RBI is supposed to give a 2.2 trillion dividends to the RBI or to the government. The market is expecting that the dividend number to move to 3 to 4 lakh crore, which is substantial number vis-a-vis what has been promised in the budget, which means that the worry on fiscal deficit, which was stemming because the budget numbers had talked about a close to 2,78,000 crores of capital gains plus short-term capital gains plus the STT, the securities transaction tax. Had there been any shortfall on that, there would have been a compromise on our capex. It looks like those thoughts may be a bit far now if RBI actually declares a dividend which is far more exceeding the 2.2 lakh the 2 lakh crores which had been promised in the budget. If that be the case of 3 to 4 lakh crore, I mean, there are different reasons why RBI can give this amount of money to the government of India. For the bond market, it's reassuring the fact that the fiscal deficit will not be curtailed or will not extend, or there will be no larger borrowings. And on macro level, the capex expenditure, which will go unchallenged. So two major implications of if RBI actually declares dividend as the market is expecting, and also the liquidity remains huge, where the value remains in the 5 year curve. One of the things that we have plotted here is India has, from a low base, India is one of the few countries in the world which has, remarkably rallied in the last one year. As I said, and hence which all said the fact that A large part of it we think has been priced in. How long can we move away from what's happening in the developed economy? It needs to be seen. Some emerging countries have already increased rates, have already started seeing rate increase, whereas India for the last 1.5 years have has seen a remarkable rate drop, which has also been seen in the remarkable inflation drop which has happened. But maybe to expect the fact that inflation to finally start moving further lower from here looks very difficult. One of the things that is going around in the global economy is in the rise of the 30-year. I mean, you have seen all across the globe what's happening is that the 30-year rates have moved up, and which is predominantly in Japan. And in the US, what happened is in the 20-year, there was no buyer for a 20-year auction. So Japan is one of the countries where the spread between 30 and the 1 year has increased. Across the globe, the 30-year rates have increased. There's virtual, buyer disappearing in the long end of the curve, that is the 30-year plus globally. In terms of the steepness of the curve, Japan has hit just a all-time high of 25 years. The implications, we're not so sure what does it mean for the global, but we do not think so. This rise in steepness has anything to do with the carry trade, etc. It's and most of the Japan anyway the Japanese government bond, large part of it is owned by the Japanese central bank also. But there has been a uniform rise in the 30-year bonds across the globe, including India. So there's been what I call the steepness of the bull curve. What has happened, and initially such yield curves when the steepens means a good economy, but this time around it's a bit of a different thing, wherein there is just no buyer in the long end of the curve. A bit of things on the US. US is steering. It's still staring at a large fiscal deficit. They've just passed the Congress has passed a tax bill again, which probably will keep the US deficit a longer the US deficit above the 6 to 7% mark. There is an increasing federal debt which is happening, which would probably have a problem, which would have problem on the dollar index as such. And what is more discomforting in the US is the fact that what we have seen is a recent spike across their the 90-day delinquencies have increased across mortgage, home loan. I mean, you have to ignore what has happened in the student because there was a bit of the pause for the student loan, but across credit, mortgage or an home line equity credit, we have seen the 30-day limits, the 90-day delinquency rate increasing, which means that the credit challenges in US may emerge. So in US, in a nutshell, weak credit, weak consumer sentiments, there is uncertainty around tariff, inflation, rising fiscal deficit, there's lower foreign investor interest in treasuries. So US looks a very difficult place now. So which also means that in you can have everybody looking into emerging markets rather than US. US is facing its own set of challenge. Whether the world can decouple from US, we are not so sure. But US has its own set of challenges now. And hence, what we talked about is that we think that in the long end of the curve, there will be we are in the terminal rate, whereas in the short end of the curve, we are now favoring the high quality credits in the 2 to 3 year. They are the sweet spot. They have the liquidity with them. There's a huge amount of liquidity. So this will help the curve. This is where the value is. And we just hope that there are no FPI outflows uh, because of the differential between rates between the US and India, coming off. We just hope that the FPIs don't go out at this point of time, and of course, oil prices, etc., can uh, can further pull down yields. But we think the best of the oil prices is a bit behind us, and inflation can marginally start ticking up from here on. So all in all, what we wanted to say is that the long end of the curve is priced in whatever RBI's action is. We are finding value in the short end of the curve up to 5 year. That is where we will be positioning our portfolios across our we will be positioning our strategy across our portfolios. That's it from my side. Uh, I'll pass it on to Krishna from here on. Thank you for listening in.
Hi, good evening everyone and welcome. I'll just try and share the presentation while we speak. I hope this is visible.
Yeah, Krishna, it is.
Yeah. So again, good evening, everyone. I'd like to share some thoughts on market outlook. As we all know, markets are pretty volatile, quite a degree of uncertainty and much higher degree of reaction to those uncertainties because partly the nature of markets, partly the nature of the people participating in the markets, partly the expectations, and finally the intensity of leverage and the risk management, the way it gets played out on the trading screen. Let's not forget, in markets, while there are a lot of long-term investors like your investors, ourselves out here, but there are enough number of people who are playing at the extreme short end of the time frame, necessarily doing two jobs: one, providing liquidity for longer term investors, and b, creating the volatility. At times volatility helps, at times hurts, but net, it volatility, if on a 25-year chart, if you see, has played n number of times volatility, and it's supported almost every time, as far as the investor profile is concerned, who's looking for a longer term wealth creation. I agree, the kind of market volatility that plays out has lured many people into thinking uh, more and more short term, but eventually we all know, it's like uh, short end uh, doesn't hurt, or long end doesn't hurt, as long as one is really not leverage should be first message, and if not leverage, why not think of long term can be the second message. Let's recap of what happened in the world. Tariff tantrums, all of us would have gone through. Maybe the more important part I'll possibly try to highlight is the third one, which is it actually has ended up becoming, the fight between world's largest consumer, that's US, and world's largest producer, which is China. I think both are trying to prove operants. As we saw, tariff pe tariff was the word. What US did, and China reciprocated. Again, US played the same, and China did. Uh, and in any event, 100%, 150% tariff becomes unviable for trade. There was a big challenge, how world economy can play out. Markets gave away. That 7 day sharp fall from 2nd April to 9th April was pretty serious. But yeah, finally some sense, prevailed more in terms of having a 90-day pause for negotiations with all countries except China. So while all of us were expecting that, countries like India and maybe somebody else can benefit far more because the tariff differential with China can create a good manufacturing options. Unfortunately, US ended up, signing deal with China itself, much ahead of signing with any other country, but for UK, because all other countries are still negotiating while we speak. I think yesterday or day before there was a delegation from India which has gone to US, I think. So those things are on cards, but if you really review it, yeah, in a way, world is pretty much same to where it was, which was 2nd April. Almost every world markets is back to or higher than the 2nd April, pre tariff announcement price point. So is the world economy, so is the market. So that's some good news, that macro concern which led to a fall, and broadly markets have recovered fully from there. The gap between China and other countries is what all of us are awaiting, because that's gonna create a roadmap for slightly more, medium term, long term implication on how manufacturing capabilities around the world can be created, can be transferred, etc. Let's look at India specific. Yeah, we did manage to sign UK FTA maybe ahead of the tariff deal with US, which is still negotiated right now. Uh, we will need to reduce some tariffs on some product being taken from USA. Intensity, we don't know of tariff, but what announcement happened about Harley Davidson bike, and the import tariff may be brought down to as low as zero. Uh, this can be some worry for some companies somewhere in Indian environment, where suddenly a global product made by some US company can become significantly cheaper than the pre-tariff price, and it can have implications. Just signing, sounding this off more as a thought process right now, in absence of specific data on what's the new tariff plan for India. Just needs to be aware, even partly from our portfolio construct side. Is there something to be monitored? Maybe answer is yes. And does any Indian company lose the import competitiveness because of tariff deal with US, where India cuts down tariff on imports into India. I think we need to monitor. Pure play, I think RBI has turned accommodative on both liquidity and rates. This is a bare minimum requirement for growth. Economy needs both money supply as well as lower cost of that money supply. So hopefully, we should be on a far better footing in FY26 and maybe 27, because sometimes, the implications of this monetary policy transmission might take slightly longer than, it's honestly not as instant as what equity market prices reflect. But yeah, hopefully FY27 growth should be supportive in somewhere near the 6.5 as per RBI estimates. We also believe 6.5 is reasonable. Unfortunately, tariff and uncertainty in the global markets can create volatility stroke, maybe a positive surprise also. Inflation is benign, which is again good sign. I think the way WPA etc. data is pretty more favorable. Let's look at India market in a macro picture. I think this is a nice chart. It's taken from Bank of America, which basically says that S&P and Nifty has nearly 96% correlation. Uh, I think in all our life we've seen this. Even Rahul did mention some sort of a decoupling with US etc. Yes, decoupling would have happened in the past, but that decoupling has stayed for a much shorter period and not really a structurally. So our markets are reasonably well linked to S&P, proven over time, and we just need to be aware of this fact. Is one thing. Let's look at Indian market specifically. The drivers of our market rally. Uh, three tables, and one is Nifty, other is mid cap, third is small cap. This graph just captures from that bottoms made in March 23 how each of the three index have given returns and what is the current status. This is dated by maybe 4 5 days, so marginally different outcome. So way to read really is that Nifty is up. Well, Nifty was up really 55% from the bottoms made of March 23. Of that, 7% has been given away. The one in the orange top, the light blue reflects the valuation expansion enjoyed during the period, and earnings growth during the period is the dark blue. So if Nifty rally was 55%, you got 7% already retraced, 26% is multiple expansion, and 22 was earnings growth. Honestly, it's not everything is not so bad, because we actually had a nice year of valuation contraction in FI in the in the period FY23, but it is just to show that we made reasonable gains on valuation expansion, partly driven by flows. I'll highlight that in the next slide. Let's look at India pure valuations and earning combo. So this is what has happened in a way post-COVID period for India, separately for all three indices: Nifty mid cap 150 and small cap, with a nice patch 4-year CAGR of nice 25, 41, and 32% earning growth in those indices. Obviously, the base effect of FY21 was pretty severe, because we had a COVID-led slowdown. Economy actually in a way contracted that year. After that, FY25 earnings more or less have been moderate. The good news really is that 26 and expectation for 27 both are pretty good. Yeah, 20 somewhere that's a big picture expectation as released by Bank of India, sorry, as BofA Global Research. And look at the valuation against this particular earning growth. We're talking about 20 times on Nifty, 28 on mid cap, and 23 small cap. This in a way are some sort of a longer term range if you start plotting those three valuation data points of Nifty, mid cap, and small cap vis-a-vis this chart. Uh, we are reasonably in range. We're not really, let's say, come back to long-term average, but at the same time, from the highs in late 2024 on valuation front. So two things have happened. Obviously, earnings have gone forward. We've moved ahead 8 or 9 months uh, into the earning growth, and to that extent, even for a same level of index value, you are actually cheaper than what it was 9 months back. So that's there. The third picture on the right actually shows how the premium of mid and small vis-a-vis large cap, reasonable correction, has happened, where the falling line basically reflects that the premium has contracted. So if you look at, the peak was 41% mid cap premium to large cap. It's come down maybe now to 17. So that's the way to review in absolute as well as relative, small caps which were, or mid cap which were slightly more expensive vis-a-vis large. More or less, lot of those retracement has been caught up, and incrementally one does believe that there are clearly some pockets of mid and small which are equally attractive, and worth from the investment perspective. Let's look at flows. This is a flow, slightly long-term chart, but captures simply, all the data point from CY 2005 till maybe current year, May. So if you look at this, we had, nice, yearly pattern of inflows or outflows. Look at CY 25, more specifically the highlighted area using that arrow. I think we actually have something like $10 billion outflow on CYTD basis, while if you look at the picture of just last 1.5 month or so, maybe 2 months, April, May, it's $3.5 billion. And if I just look from the bottoms made in April, I think we got something more closer to 47,000 crores, which is slightly over $5 billion of inflow. So yeah, flows have clearly supported the kind of rally. I was actually reflecting about today's market levels, and if you really go back, some of these market levels were hit for the first time somewhere in October 24, from a Nifty angle, and maybe in January from NSE 500 angle on the way down, which means that today's Nifty level, assuming it's somewhere at 24,700 or so something, you had almost similar number in October 2024. So you got a nice, whatever, 8 months odd time frame. The beauty of it is, it actually took nearly 6 months to fall by maybe 3,000 points, while the rally up has taken just about 6 weeks. Whether it's Nifty or NSE 500, the fall from that October, towards similar levels to 9th April, or maybe 7th April rather, the markets made bottom, and from 7th April till 23rd of May, just about 6 weeks. So what was lost in 6 months odd broadly has been recovered or recaptured in 6 weeks. That's the nature of market. That's the beauty. That's where it says that the time invested in market, honestly, is far more important rather than trying to time those market. I'll show you some data point on people who try to time the market. Unfortunately, it was pretty scary to think of it. Look at the flows, other side of flows. Anthony did mention, but this figure just mentions little bit more finer details of how these flows have gone vis-a-vis sectoral funds, vis-a-vis small cap and mid cap. So if you see this clearly, the mid and small cap has broadly remained similar, whether it was September or whether it is March. April data is not out here, but it's not very different again. So what has really been impacted on the flow really is the thematics, but the core investor base from a small cap mid cap perspective has broadly remained similar or identical. Uh, this is another angle one needs to be aware. New supply. See what does the when we track flows on the upside, kind of support for market, we should always try and track the flows on the downside. In a way, with some hindsight, gives you some reconciliation point for what really went wrong in CY 24 was the Indian markets really had a record fundraise by primary issuances. Actually, it was record on every front. It was record on number of companies doing IPOs as well as number of the sheer amount of money raised. I mean, when you look at this particular slide and figure out IPOs in India raise more money than IPO in Nasdaq, or even NYSE or Hong Kong, it does strike you, right, that the amount of money raising, and for every IPO new comes in, you got two things. One is on a positive side. As an investor, we get chance to participate in new business areas or new business opportunity, different management, different story on growth, etc. But the reality is that the sum of money being constant, some money needs to be pulled out from existing investment portfolios to be put into those companies. So to an extent, put supply pressure on the market overall, where now there are more stocks to invest rather than earlier, and to that extent needs to be aware because and this is actually a very self-fulfilling mechanism. Markets does very well, you have more supply of IPOs, and market does bad, supply somewhere reduces. This needs to be aware. Outlook on markets, I'll possibly not I mean, this is there. Global markets are stable, as I mentioned. Almost every markets are higher than pre-tariff days. We had a leverage-driven volatility in India. It's a very interesting day, 12th May. We had series of positive news. India Pakistan ceasefire, America China peace on tariff, etc. We actually had a great day with nearly 4% up move in Indian markets, but unfortunate part really was a pretty low amount of institutional buying. FII, DII both were positive that day, aggregate buying something like 2750 crores, but markets were really up 4%. Possibly this tells you, the intensity of leverage participants in the market. We call it sometimes short covering, etc. But net, that's one angle to be aware of. Uh, Prefer favorable still risk reward wise large cap, while flows are supporting mid and small. India core story is intact. You got nominal GDP growth that's going to generate corporate earnings on one side and investable surplus on other side. So DII flows are going to be good. As a macro, principle in any economy, the profit pool keeps on shifting between, you know, investments phase or consumption or the global trade. And that's a beauty. We try to track, we try to figure out where gives more comfort on incremental earning growth over next 12, 18, 24 months kind of time frame. This is more sectoral split. Individual company will definitely have their own different trajectory, which again are part of bottom up stock selection. DII flows will be supportive, as Rahul mentioned. Most probably EMs should outperform. DMs is possibly is a thought process. Uh, from equity outlook, yeah, we moved nicely. Normalization in key shape, recovery post COVID. For the first time in last 8-10 months, we're discussing a flow where the rural recovery is better and urban India has its own growth challenge. It's not degrowth, it's just a growth challenge. But yeah, so that lower part of K shape which was missing, I think is playing out now. Government infra spends have a decent growth, but base was poor. Monetary policy benefits should come in now. Lower oil price clearly is the biggest benefit. If biggest we call silver lining for India really is a lower oil price, helping us on multiple fronts. Yeah, till this tariff uncertainty is not fully done with, prefer little bit low earning volatility. From a preference angle, these are the ones, but I'm sure in the sectors which I have not mentioned, there are clearly some bottom up ideas which our funds do participate in. So doesn't mean that we clearly we are avoiding other sectors, just that some bottom up good ideas will play out there. Any export related company, one would like to monitor tariff talks for better clarity, because suddenly the profit pool can reduce, or volume growth can come down based on what the new price point for American customer can be for any product coming from Indian basket. So that's mainly from my end, and we are happy to take any questions.
Thank you, Krishna. Let me start with, I think right at the beginning, Rajesh reacted to something I said, that I mentioned equity savings fund. Please look at it. The performance is subpar. So Rajesh, I can understand the last 1 year number is perhaps sub on a relative basis because we've had at times a higher equity allocation. But the 3 and 5 year numbers are incredibly strong. It's a quartile one fund over 5 years. I'm not suggesting, honestly, 5 years, just to bring everybody's memory back, very challenging to look at 5 year numbers now and make conclusions. Because if you remember, 5 years ago, we were in May 2020, right? Just at the time of COVID. So all returns look amazing. So even the equity savings has a 16% CAGR since May 2020, and that clearly is not a return equity saving products give. My simple point was that if clients want to be a little more risk averse, or they are being risk averse, what do we as advisors can suggest? I'm just saying hybrid can be a better solution for you to offer clients than trying to maneuver SIP or STP in a classic equity fund. That just may work for some set of clients who are not wanting to commit too much for the long term at this juncture. Uh, Mr. Deshmukh saying mid cap and small cap uh, is overheated. So is SIP advisable for a 10-year period? Again, I'll answer that for now. SIP is advisable for a long term. So there's no doubt about it. Uh, Frankly, not just in mid and small cap, you could argue you could equally have that SIP going in for 10 years into a flexi and a multi cap. And at least my personal preference at this juncture of the market, if I had to start a new SIP, I would probably pick a multi cap fund or a flexi cap fund to start that SIP as opposed to mid and small cap. But the moment you look at 10 years, small and mid cap is also fine. But preference for me right now that I think clients should be doing would be multi and flexi cap. Krishna, would you agree?
Yeah, I agree. Anyway, multi-cap, by nature, anyway, gives a minimum 50% exposure to mid and small. So, the core requirements of a mid and small is anyway, captured there.
Yeah. Mr. Asif has a complaint. So like I said, I apologize. His point is every fund house has a conference call twice a month, but you guys don't update. Mr. Asif, I'd just like to clarify. I don't think just doing a conference call every 2 weeks, saying pretty much the same thing is going to make sense. In fact, a lot of our distributor partners gave us the feedback saying everybody does your conference call in the first week of the month, and beyond a point how many calls can we attend, and everybody says the same thing most of the time. So can you switch your call to the third or fourth week of the month, because at least there aren't calls at that point. It's just useful for people to listen. So once a month we will definitely commit to. I think beyond that, my personal view, making money in equity is about just investing in the long term in a disciplined manner. Frankly, somebody like me who's been in this business for 30 years, if I keep looking at markets, looking at positives, negatives, end of the day, I just end up getting more confused in a sense. So like I said, I apologize for not doing this call last month, but I don't think you can expect, we wouldn't want to do it twice a month. I think it's just overdoing it. Krishna, the next question is for you, from Mark Consultants. You have shown the earnings chart. Why the small cap earning of FY26 will be close to 5 to 6%? What is the reason for the fall of this earning?
So there are two parts of it. Partly the base. I mean, 25 was good. If if I'll just try and share the screen again. So one of the reason really is the base effect, which says if you look at FY25. If you look at FY25, actually small cap had the best earning growth. Like, Nifty was 7, mid cap was 11, and small cap was you know 15. So partly the reversal. I think the second part equally relevant is that for a change, the commodity companies are going out of that year last year, negative or a low growth or a degrowth kind of situation. And normally it's understood that small cap companies are actually resource consumers rather than resource producers, while large caps are resource producers. So, like for example, we had this steel prices right now, having gone up because of anti-dumping duty. Almost every steel company will typically be a large cap, and steel consumer on an average will be more small cap than others. So little bit adjustment of that profit pool participation between resource producers, resource consumers. That can be, to my sense, the core reason. This slightly aggregate data. So with 250 companies, honestly, two, three, four companies with a huge amount of loss, etc., can also drive those things. But my bigger sense is some sort of a reversal of earning growth in 25 is possibly first, and second is this resource producer, resource consumer story.
Okay. Uh, I'm just going to take a stab at the next question, Krishna. If you disagree with me, please do actively disagree. What are the tactical calls for current market scenarios? I mean, I obviously get my gyan from talking to Krishna and Rahul, and thankfully for you, I don't manage funds, and they do. But I think the tactical calls are very clear. That and we've said this in the past. Deciding is small cap better, mid cap better, large cap better. Eventually we've shown this in presentations in the past. It all evens out over 3 to 5 years. And so, to my mind, the tactical call is invest in stages. Maybe I wouldn't necessarily jump in to put in all money, maybe over the next 2, 3 months. And I would principally use, and I'll just talk about our fund specifically as well, multi cap, flexi cap, hybrid, aggressive hybrid, and multi asset. That would be my tactical calls. And the focus fund that Krishna runs, which to my mind is something. If you have belief in the kind of numbers Krishna has been able to put up, not just here but through his career, that's a personal favorite. I just want to spend one moment on tactically, because the question is, what is a tactical call? Interesting for me personally has been looking at the funds that in the flexi and multi-cap space that have done well in the last 6 months. The reason I say this is, in some sense, my belief is the market has changed in the last 6 months in terms of how investment fund managers and investors are thinking about the next 2, 3 years. In some sense, the darlings or the favored sectors, stocks, spaces, themes, I think has kind of shifted. And somewhere I look at the last and I think about, in the last 6 months, if I see funds that have done well, I just try to look at it. Is it that they seem to be better positioned for what this market has become? And it's always very challenging to find a conclusion, but I want to just draw your attention. In our own fund complex, there is one fund that over the last 3 years, and I'm just giving you context, in the last 3 years, we've got net equity flows of something like, I think, about 11,000 crores. The one fund that's accounted for only 3-4%, and to my mind has been the one fund for of ours that seems to have been the best positioned for this market shift, is our flexi cap fund. And so my one tactical advice to all of you, at least in terms of our fund house, is please take a deeper, closer look at our flexi cap fund. There is another question. I don't know the name. What categories to look at fixed income? Uh, I think Rahul spoke about it. Our view is that a lot of the longer term bond funds have gained a lot as interest rates have come off. Our view is there's going to be a pause of easing of rates or yields coming down. So we would probably focus on low duration and short term bond if the customers got money, which is at least 6 months to a year. The other category is a category that some AMCs have launched. We have just filed an offer document with SEBI. This is a fund of funds which is investing, excuse me, in bond fund and arbitrage, so that the treatment is that it is eligible for capital gains tax after 2 years. I think that's a very interesting product for your clients who has a 2 year perspective. I think it can be a very, very viable proposition. I think a number of fund houses have already launched it, so you should look at those funds for sure. I would say those three are clearly the standout candidates. There's a comment, your manufacturing fund has not done well. Uh, I agree. This is a point that's come up in the past. Just to clarify, we spoke about this about 3-4 months ago. We've made a number of changes to the way we looked at portfolios. Like I said, markets have shifted. And in some ways, our manufacturing fund performance is a tale of two halves. If I look at our 9 month performance, it looks like quartile 3, quartile 4. Our 6 month performance is quartile 1, right? So for practically speaking, it's a just a base effect. We've made whatever changes we needed to make to our manufacturing fund, and at least I can give you reasonable assurance that Krishna and Ranjit are very comfortable with how we now are positioned as far as that fund is concerned. Mr. Gangwani has asked a question, and Mr. Oja has asked another question, which is kind of linked. Mr. Gangwani's question is, "What is the gold investment? How should one look at the gold?" And Mr. Oja has asked, "What's your view on multi-asset and how you expect golds and commodities to behave?" My quick answer is, and this is again, I'm just repeating a conversation that Rahul and I had a few weeks back. We don't we don't want to be caught in the fact that because gold has performed like it has over the last 2 years, uh, we think that it's going to be much more normal from now on. At the same time, what it has taught us in the last 2 3 years is it's always useful to have maybe 3 to 5% of an overall portfolio in gold and silver and stuff like that. I'm just going to use Mr. Oja's question. I genuinely believe, and I know a number of my peers in the industry believe, that multi asset fund should ideally be at least 10% of any of your customers' portfolio. Now, logically speaking, since multi asset as a category is relatively new, there were a few that launched it in a fund of fund format 5 6 years ago, but by and large, I'm quite sure that 90 to 95% of clients do not have multi asset as 10% of their portfolio. I believe over the next 5 to 10 years, multi asset should be at least 10% of any client's portfolio, because you're allowing the fund manager to make the right calls between equity, fixed income, and gold. I will also make the point, I've made this before. I am referring to multi assets that are using hybrid tax so that they genuinely have the flexibility to do equity, fixed income, gold, commodities meaningfully. If you have equity tax as your multi asset, it reduces your flexibility. Obviously, the call is yours. But I am very, very clear that 10% of your client's money that you've allocated to Mahindra Manulife, 10% should be in multi asset, would be my very, very confident advice that I'm happy to have a conversation 5 years from now and stand by. Uh, US rating goes down from AAA to AA. How does it affect the market? Again, in the interest of time, just to clarify, Moody's was the last rating agency to cut the rating to AA. The first rating cut happened 10 years ago. So there is disruption clearly that is happening because of the bond markets in the US and the deficit. That is the larger issue that Rahul talked about. The AAA to AA, to my mind, has already been digested by the market, and it doesn't seem to have had an impact. What's of a larger impact is what Mr. Kulkarni has asked. The US debt and interest burden, the big dollar depreciation. I think the limited view is that from now, one of the risks that could derail markets in the short term is if the US goes into a bit of a very volatile phase. I think we may wish it to be decoupled, but markets globally is not decoupled from the US. And frankly, debt markets in the US bear far more close watch than equity markets, because the moment debt markets start creating or signaling perception of issues, I think equity markets will react. So that would be one factor that we are watching out for as well. But like I said, these are not, we are, none of us are discussing things that are not known. So to that extent, what this is all suggesting is that in the next 3 6 9 months, although it's really crazy and stupid to be even thinking about what markets will do, uh, markets will be range bound. It's really impossible, I think, for anybody to take a call one way or the other. Uh, our perspective on silver, we are equally positive on silver as we are on gold, which is therefore neutral, right? So between silver and gold, at the margin, we would be probably more pro silver. but we also believe that the gold silver large rally has broadly happened, and we will return to some kind of normalcy at this point. Krishna, there's a question on the defense sector. Given the prospects of defense, but given valuations, what's your view on defense as a sector?
I think defense as a sector is pretty good from a business perspective. Maybe valuations have actually run up a lot more so, in the light of India Pakistan, ceasefire and all the news flows about, how Indian defense played out very nicely. Actually, Indian attack played out very nicely is the right word, and not so much defense. But yeah, I think structurally very positive. All the ingredients in place for import replacement, for higher spend by government, and with some sort of a proven capability, the export potential coming up for companies. Challenge is valuation, especially when the stocks have run up in a pretty short period of time. One ends to reevaluate more in the context of valuation, but otherwise, yeah, structurally quite positive.
Okay. Krishna, there's a further question because I think I refer to the focus fund. If one had to look at it as a split between large, small, and mid, what's it like right now?
I think large cap will be something around 86, 87%, and small cap should be around 8%, and pretty less for mid cap. I can think of only one stock maybe in mid cap right now. So
Okay.
I mean the fund, little bit goes on valuation, comfort, from a style value. So you typically find mid cap being slightly lesser weight because on an average, mid cap multiples are higher than large and small.
Got that. There's a series of questions again on the manufacturing fund, which just suggests to me, message to our sales team, we're not doing. So our manufacturing fund, I think we just all have to be clear. Any fund that was launched 1 year ago or 9 months ago, obviously markets are still lower today than they were at that point. The manufacturing fund, and there is a question about large and mid. To be honest with you, those are the two funds that we clearly had a very challenging April to August, in the sense of it was a period of 4 months where a number of things didn't work out for those two specific funds. So I just want to point that out. I mean, the moment we have a discussion in August, suddenly the 1 year number will look very different because the base is now August 24. It's not July 24 or May 24. So I just want to assure everybody very clearly that Manish, who runs the large and mid cap as well as multi cap, is very comfortable with what he's needed to do. I'm not trying to run away from the fact that the large and mid does have an underperformance over the last 1 year. It has a very decent performance over the 3 year time frame. But by and large, there are, manufacturing, we raised money in June. Markets did obviously take a nosedive after September. Uh, but I'm making the point. Manufacturing is out of 12 manufacturing funds that we track, and this is, technically this is not the right thing. It's not permitted really, but just to share with you, we are ranked number 3 in 6 month returns, and so clearly things are working out. Now, if the expectation is should be 1/11, we'll always try. But our approach is never meant to land at number one. We'd like to be in the first two quartiles, and large and mid as well is something that used to be a flagship fund for us. We've delivered great performance. The last 1 year hasn't been great, but I can very confidently tell you that it was a April to August situation. I'm very clear that we've figured out what we need to do, and has been done. And the moment you have a period like August of 25, all of our 1 year, 2 year, 3 year numbers in that fund will look very different. It's just maths, by the way. Nothing else has changed in the fund. Business cycle, can you guide, because it's not performed well since inception, is an anonymous person. Honestly, I don't know how to respond to that, because if a quartile one performance since inception is means it hasn't performed well, I can only apologize. Honestly, I can't ask my head of equities and my fund manager to target beyond quartile one performance. So my apologies for that. Uh, if Mr. Rajgor, you've recommended multi-asset. If a customer already holds gold and FDs in overall portfolio, then does aggressive hybrid make more sense? Uh, yes, Mihir bhai, if the gold and FD is material, मतलब अगर उसका पोर्टफोलियो में एटलीस्ट 20-25% गोल्ड एंड एफडी है तो फिर बनता है सेंस कि मैफ को इग्नोर करो, अग्रेसिव हाइब्रिड कीजिए. But otherwise, I would say, you know, by and large, multi-asset. Aggressive hybrid, honestly, is my suggestion for any customer right now, especially given the way the portfolio is positioned. Fatima runs that fund as well. It's got an incredible consistency in the way it's done, delivered over the last 3 to 5 years. And I just think it's probably the best product to deliver to clients who are apprehensive about markets. Doshi ji is asking, Krishna, maybe because you obviously ran the business cycle fund, uh, what themes or sectors right now the business cycle is focusing on?
Sure. So partly it's captured in that slide on that incremental equity outlook. But if I just think of it, currently the idea is slightly more focused on India specific companies or India focus earnings. But so yeah, BFSI finds a space there. You got even power sector as a nice a little bit flavor or orientation towards old economy, which means power metals within metals. Ferrous is a nice space. Uh, Consumption is another flavor, yes. So I think those consumption, power, and steel within metals and power, mainly those. But yeah, I do have some stock select specific bottom up ideas, even from IT or even from pharma. So it's a combination. And see,
Okay.
right now,
Yeah.
the challenge is, as I mentioned, quite a few sectors which can be troubled because of tariff is something one is trying to possibly monitor more for some clarity rather than rushing into buy now.
Okay, I'm going to take the final question because there are a couple more, but there's a question on how embedded in our ESG strategies in your core offering. To some degree, they're embedded. We are very clear that just think about our framework: growth, GCMV, growth, cash flow, management, valuation. A part of assessing management will always be governance. So I would believe the governance part is definitely something that we are looking at very closely. We are one of the few fund houses to have a dedicated equity strategist in our office. Manulife has a very large ESG setup in Asia, so we have constant conversations with them. So we are ESG aware, but we don't beyond a point influence our portfolios at this juncture with ESG. For that, we would prefer to launch an independent ESG fund. In the interest of time, Krishna, I'm going to, because you are the fund manager and it's a fund that I personally, I remember on the last call we did, two calls
Hmm.
back, to this very audience. We've launched the value fund. It turned out to be, and I remember tweeting about it. Any fund that is a struggle to get money in the NFO normally does well. But want to just share your thoughts on how the value fund portfolio looks like? How is it shaped up?
Honestly, value fund as a got some nice entry points on some companies because you actually had entire month of March and early April to invest. Yeah, could not or did not capture the fall of that tariff week because we were broadly invested even in the first month end portfolio itself. We were 80% plus invested, but no regrets because March itself was a nice opportunity. I think from a large mid small it's around 53-54% large cap and the remaining is mid cap, maybe 5-6% cash is what I can recollect. Thematically you find let's say power is a space which is there as some sort of a call. PSU banks is another area which we've taken some higher conviction bets on within the value fund, little bit on metals, I guess. And then there are again, honestly, value as a theme is going to be far more company specific rather than pure play sectors because in every sector you'll actually figure out or find some value. So in fact, by the way, what I did mention about business cycle versus if I look at IT sector, I do find IT has a lot of value vis-a-vis while the business cycle may not be right now in its favor in terms of the earning expectations for next 6 months need not play out the way it is. But if you just sit back and think, almost every IT company is available at more than 4% free cash flow yield, zero debt, amazing ability to do buybacks or do full payouts of dividend, whichever way they think is right to. Uh, 'Cause nowadays tax efficiency is as much same, or tax is indifferent to whether buyback or dividend. So you have a nice potential. All you need is little bit comfort to play out on US economy, which is an underlying operating geography, and you have a nice earning uptake also. So even IT finds some space there.
Thank you, Krishna. And thank you to those of you who've written some really, really sweet words on the chat. Thank you so much. It gives us a lot of encouragement when you write stuff like that. Thank you, Krishna and Raul. A number of people commenting. Thank you for the session. It was useful. Uh, yeah, so I'm just going to close here. For a change, we've gone 11 minutes over time, but that's because of the number of questions. I hope it was useful. I want to end with the apology again. It's never been our intention to skip the monthly call, because for me, and I think equally for Krishna and Rahul, it's a great opportunity for us to engage with people like you who effectively are our voice, our ears, and the folks who give us the money from your customers. So thank you so much, and look forward to having a conversation. I'm guessing around the third week of June or thereabouts. Thank you so much.